Hey, thanks everybody for joining. Welcome to Antenna's State of Subscriptions webinar. This is our quarterly evaluation of the subscription industry. And today we're going to do a wrap up of 2024 with a focus on the premium streaming video category. I'm Jonathan Carson, co-founder of Antenna, and I'm joined by Brady, our director of strategy. Just quick background on Antenna for those who may be newer to us. So Antenna is a data and analytics company focused on the subscription economy, and we have a special concentration on the video streaming category. We measure the financial transactions for about 2 million Americans. We use that data to count the number of subscribers to all these services, but also, as you'll see today, provide all sorts of deep analytics on acquisition and churn. Okay, so let's talk 2024. We think this is a year that the premium streamers really kind of grew up and matured as a category. We heard this a lot in the industry talked about as under the terms of profitability, particular players reaching profitability or being close to reaching profitability. If we unpack that idea, though, we think there's something much deeper going on. So for the first several years of the so-called streaming wars, premium streamers have been focused on acquisition for the most part, and this made a lot of sense. There were a bunch of new brands who came into the market, who had to build awareness, they had to stimulate trial, they had to get consumers familiar with their offering. And for all the noise in the marketplace, they were actually really successful at that. If we take Paramount Plus as an example, Antenna estimates that over 65 million Americans have tried Paramount Plus, and that's a brand that didn't exist 4 years ago. So with this established base, the streamers are now working to transition to more sustainable business models. And again, the industry talks about this in terms of shifting their focus to profitability. But really, if you think about what streamers have been trying to do, they've kind of been trying to pull off a triple Indy. Number one, raise prices. Number two, condense programming and marketing budgets. And number three, do all of that while lowering churn. I'd say generous people in the industry would say pick two, and a lot of people say pick one. But the amazing thing is that what we see in the data is the premium streamers, for the most part, are kind of pulling this off. And so there's still lots of questions in the industry. Can this new model be as lucrative for media companies as the linear pay television model has been for the last several decades? That is certainly important. But reaching profitability and establishing these more sustainable business practices, they're a big milestone. And we see the streamers are showing progress across a whole bunch of different performance areas that are part of that goal. And so that's what we want to really highlight today. So the 2024 Year in Review edition of Antenna's State of Subscriptions focuses on that transition, highlighting some of these key achievements. All right, so let's talk first about churn. Right up front, we want to highlight the fact that the category is still growing. So Antenna estimates that premium SVOD grew over 10% in 2024 and actually surpassed a big milestone, 250 million total subscriptions. Share's been pretty stable across the category over the past 2 years after lots of change in the years prior to that. We would call out Peacock and Paramount Plus in the last 2 years have been the two share gainers. All right, so this is Antenna's volatility chart for premium streaming. And the way to read this is the green bar on top is the total gross ads for the category for that particular period. The red bar on the bottom are the cancellations for the category for that period. And then the dark blue bar in the middle is the resulting net ads. And we think this chart is helpful because it really helps to explain the financial pressure that the streamers have been facing these past couple years as they graduated out of that hyper growth phase. And you can see this in really jump out in 2023. The gross ads are up, but that green bar, that's good, but the green bar has a lot of cost associated with it. That green bar is essentially acquisition cost. The cancels in 2023 were also up dramatically, 31% year over year. And that red bar also costs money because cancellations are expensive. That's your retention costs. And so if you've got the acquisition costs and the retention costs going up, but the net ads, the productive growth of the category is shrinking. So it went from 37 million was our estimate in 22 to 29 million, less than 29 million in 23. That's a tough place to be. Note, in 2024, the story looks a lot better. So gross ads up again, about 12%. Cancels still growing, but a significantly more modest rate. So we saw them at 16% growth in 2024 versus that 31% from 2023. So the result of that then is the net ads still down just a little bit, but a much more modest decline at about 27 million. So how does that translate to churn? So to be clear, churn definitely still a major issue for the category. And it's been on a steady rise since we've started tracking the category in 2019. But what do we see here? At the start of 2022, Antenna saw a churn just going a hair below 4%. Beginning of 2024 was nearing 6%. So a big increase over those couple of years, but a glimmer of positive news. Let's look at Q4 of 2024. All 3 of those months in Q4 down year over year for churn. We saw the same thing, by the way, in January of 2025. Still too early to call this a trend, but it suggests that the category is at least settling down from a churn standpoint and maybe even moving in the right direction. And that churn picture looks even better when you factor in the fact that there's a huge portion of those churners who actually come back to the service in the months following their cancellation. And so I'm going to pass to Brendan to talk about that dynamic.
Awesome. Thanks, Jonathan. So yes, churn is that measure of how consumers are canceling a given service. But as Jonathan kind of teased, we're not sure that actually tells the full story of consumer loyalty, because in so many cases, we see that these people are coming back after they cancel. In fact, in 2024, across those nearly 150 million gross ads that we measured, 32% of those gross ads were made by users who had that same service in the prior 12 months and had canceled it. And so we really believe that how people come back to these services and the aggressiveness in which they do come back is a really important facet of this whole churn dynamic. And here's kind of our stab at putting some numbers behind that. So gross churn here is across the 9 premium SVODs, and it's how we've typically always displayed churn. It's the same line that was featured on the chart that Jonathan showed. Whereas net churn, we mess around with the numerator in the calculation to a degree. We add back those resubscribes, and so it's sort of less punitive. It's not just purely cancels, it's cancels less those resubscribes. And so on a net basis, when we look at churn, because we are cognizant of this fact that people are coming back and quite aggressively after they cancel, when we look at churn on a net basis, you'll see that in most months of 2024, it was below 3%. And so that's a dramatically different picture of consumer loyalty than if we are to just look in a vacuum at kind of gross top line churn. In addition to winbacks being up, Jonathan spoke a bit about how it was a pretty tough proposition that the streamers had in front of them. They were being asked to raise price, to condense programming and marketing, to still grow subscribers, and to lower churn. All of those things are kind of competing priorities. However, as we have seen just kind of halfway through this presentation, there are key indicators of a lot of success on those fronts, and price is an especially interesting one. So if we look at the average price paid on a monthly basis across the premium SVOD category, we have this at the service level as well as at the category weighted average, split out by ad-free and ad-supported. To be clear here, this is just the subscription component of those ad-supported tiers. There is nothing by way of advertising revenue or things of that nature. This is purely just that subscription piece. And so both tiers grew over 20% at the category level, both ad-free and ad-supported for the average monthly price paid. And so the streamers have effectively, done a very successful job at raising price while also still being able to show signs of success and achievement on those other fronts that we've discussed. In addition to consumers just paying more overall, and perhaps this is kind of a function of that dynamic, we've really seen ad plans succeed. So when we talk about this report, we're largely speaking about the 9 premium SVOD services. For this little section here, we're actually going to remove Apple TV Plus and Stars, just given that they do not currently offer ad tiers, and we really want to get at the consumer behavior when that ad choice is present. And if we look across the 7 premium SVODs that offer both an ad-free and ad-supported tier, what we find is that in 2024, 57% of gross ads were ad-supported. And so here's both subscriptions and gross ads on an annual basis, again, across those 7 premium SVODs. So in 2023, 36% of subscriptions were ad-supported by year end. That grew 9 points in share in 2024 to 45%. And we see it as there's signals that this shows no signs of slowing down. And that's evidenced by the gross ads chart on the right. If we look in 2023, 45% of gross ads were ad supported. That really popped in 2024. It increased its share 12%, or 12 points, I should say, to 57% of these gross ads across these 7 services being ad supported. And there's no crazy outliers here. It's true across each service that offers ad-supported tiers. So here we're looking at 2023 gross ads versus 2024 gross ads at the service level, cut in that same way by ad-supported versus ad-free. 5 of 7 services saw the majority of their gross ads being ad-supported in 2024. Paramount Plus saw the biggest share swing, up 19 points from 31% of ad-supported gross ads in 2023 to 50% in 2024. Newer ad tiers, Disney Plus at 63% of 2024 gross ads, Netflix over 40% for 2024. We're certainly super interested to see where the complexion of these subscriber bases and gross ads kind of net out quarters from now, years from now, and so on. Additionally, distributors are really taking hold and driving growth for other services. It's obviously been a core part of Antenna's measurement is the ability to cohort metrics by the owner of the billing relationship or the specific ecosystem that they're kind of paying for that service in. And what we're finding is that certain distributors are allowing other services to achieve things, right? And so a case study we wanted to use was Apple TV Plus's recent launch on Amazon channels. What we're finding is of the people who are joining Apple TV Plus via Amazon channels, most of them are new users, meaning they haven't had Apple TV Plus in the past. And so here you can kind of just see the pop in Apple TV Plus acquisition coinciding with their launch in mid-late October 2024 on Amazon channels. And so by December 2024, Amazon channels actually represented a quarter of Apple TV Plus signups in that given month. But perhaps more interestingly is who these people are. And so on this chart, we're looking at October, November, and December signups to Apple TV Plus in aggregate. And this is split out first by distributor on the x-axis. So iTunes, about 5.5 million signups through that channel. And then by Amazon channels, about 1.5 million signups via that channel. Then we take those people and we've cut them by new users, meaning people who have not had Apple TV Plus by Antenna's measurement, and returning users or users who have had Apple TV Plus in the past by Antenna's measurement. On iTunes, 52% of signups came from people who had the service in the past, canceled, and re-signed up. Whereas Amazon Channels is really seeming to reach more of a newer user base. So 73% of signups via Amazon Channels to Apple TV Plus being these new users. And so it highlights a really interesting dynamic and sort of opportunity area around different distribution channels and their associated audiences. Jonathan, I'll pass it back to you for bundles and live events.
Okay, great. So let's talk bundles. The Disney Max bundle is exciting for the industry for a couple of reasons. First, it's getting some real customer traction. And second, those customers are proving to be sticky. So let's dive into the bundle dynamic. Okay, so if we go back over the last couple of years, there has been a lot of bullishness around bundles, and a lot of that has been driven by the fact that the Disney bundle and the Apple One bundle have had really strong performance. They've both made up a meaningful portion of the total subscribers for the services that make up those company bundles. And then their churn has been noticeably better than the churn for the services that make them up. So, incremental customers and more loyalty, it's kind of a subscription marketer's dream. Those, though, were company-specific bundles. They were the products within a particular company. And there's been more of a challenge with making cross-company or intercompany bundles work. Not only are they kind of complicated to negotiate, but once they are negotiated, the participating companies might be a little bit hesitant to put real marketing muscle behind them. And the logic of that is, if you're in a world of limited marketing dollars, which we all are, do you really want to allocate substantial resources to a package where your brand has to share the spotlight and you're probably getting less economics than you would if you sold your service by itself? So while we've seen lots of these intercompany bundles announced, we haven't really, over the past few years, seen any big breakthrough. But the Disney Max bundle is truly breaking through. According to Antenna estimates, we've seen about 1.6 million signups from launch through the end of 2024. And that was over 10% of acquisition for both Disney Plus and for Hulu, over 20% of acquisition for Max. And I think bundling in general is especially really interesting when we look at these Disney Plus numbers. If we look at Disney Plus in Q4, Antenna estimates that almost 4 out of 5 of their new signups came via some bundle, either the Disney company bundle or this new Disney Max bundle. Okay, so are bundles truly stickier than single services? The Disney Max bundle is really an amazing retention story. So Antenna estimates about 80% of the people who signed up for that bundle remained subscribed 3 months later. That is higher than the Disney bundle. It's higher than the category leader Netflix, and it's dramatically higher than the retention for the individual services that make up the bundle. They are all at about 55% 3-month retention. So obviously this is just one package. It's still early. This is just the initial months after launch, but we really think this could be a wake-up call for the industry, that cross-company bundles could truly be a game changer and live up to the promise and the excitement that the industry has had around them. All right, our final indicator is the success of live events in driving acquisition. And, Paramount Plus and Peacock have really written the playbook on this one over the past couple of years. They have been acquisition machines. They've grown their user bases very quickly. And their acquisition strategies have really been rooted in creating big moments that drive spikes of interest in the service. The biggest moments for those two services have obviously been live sports. especially the NFL and especially big postseason games and exclusive games. But beyond the NFL, they've also seen big acquisition spikes from EPL, Champions League, WWE, the Olympics. So it's worked. Paramount and Plus, as we saw up front, have been share gainers in the category for the past several years. In addition to that, services like Apple TV Plus, Max, Stars, they have also been able to drive those big moments, but more around big scripted show launches. Netflix, on the other hand, has been a very different and unique story. So the Netflix proposition and therefore their acquisition patterns have been much more around the brand, the large holistic catalog, the product offering. People are signing up for Netflix much more than for a particular show. And the result of that is that the Netflix acquisition pattern, going back many years, has been steady Eddie. They did have a stair-step increase in acquisition in mid-2023 with the motivated by the password sharing crackdown, but otherwise quite consistent. So it was a big deal when Netflix started going more aggressively into live events. And there were a lot of questions. Would this drive those same surges in acquisition that other services have seen? Well, the results have really been impressive. The Paul Tyson fight was a very big acquisition moment for Netflix. Obviously, that was a big global pop culture breakthrough. But specifically in the US, we saw about 1.5 million signups to Netflix in the 3-day period around the fight. NFL on Christmas Day, smaller, but also meaningful. And if you consider the type of breakout, the magnitude of that breakout compared to Netflix's just regular steady state of acquisition, this was a really big deal. And it gives Netflix a new tool in its arsenal to drive their business going forward. And I think reinforces the role of big events as acquisition drivers for the category. Now, it doesn't matter if you have these big acquisition events if you can't actually hold on to those subscribers. So how did Netflix actually do on retention for these signups? The answer is pretty well. Netflix, as we talked about in relation to the bundle signups, Netflix is the retention leader in the category by far. Now, the 1-month retention for the Paul Tyson fight didn't quite measure up to Netflix's normal benchmark. So the benchmark number for Netflix retention in 1 month is 86%. We saw the Paul Tyson fight, 1-month retention, 79%. But it did still exceed the category average. So the category benchmark for premium SVOD 1-month retention is 74%. So they hold on across the category to about 3 of 4 people who sign up. So the Paul Tyson fight, despite the fact it was anchored around this very big unique moment, still exceeded those category averages. So good indication for Netflix using this tool in the future as well. Okay, so that is our Q1 report. Really appreciate you joining today. As I mentioned up front, if you want to download the report that accompanies this webinar, please go to our website, antenna.live, antenna.live. And if you're an existing Antenna client, make sure you get the much juicier version of the report. If you haven't received it already, just reach out to your Antenna customer success rep and they'll be happy to send it to you. Thanks again for joining today.